Here's a friend keeping $10,000 in a savings account for 20 years, feeling proud every time they check the balance. And here's a stranger who put the exact same $10,000 into the stock market and walked away. 20 years later, the saver has $12,000. The investor has $56,000. Same starting point. Same amount of money. Same 20 years. The only difference is one decision made on day one. And that's what we're breaking down today. Why saving alone will never make you wealthy, and what you need to do instead. Here's the advice almost all of us grew up with. Save your money. Put it in the bank. Don't spend, just save. It sounds responsible. It sounds safe. But if saving alone actually built wealth, everyone who diligently saved every month for 30 years would be rich by now. Most of them aren't. So something in this advice is broken, and today, we're going to expose exactly what it is. Let's start with the silent killer, inflation. Every year, prices rise. Food, rent, transportation, healthcare, education, all of it gets more expensive. Historically, inflation runs somewhere between 3 and 6% a year. Now compare that to a typical savings account, which usually pays somewhere between 0 and 2%. If inflation is running at 5% and your bank is paying you 1%, you are not growing your wealth. You are losing more than 4% of your purchasing power every single year. Your balance goes up. What that balance can actually buy quietly goes down. That's the trap. You feel like you're winning because the number on the screen keeps climbing, while the real value of your money slips away in the background. Let's put a number on it. $10,000 sitting in a savings account at 1% interest for 20 years grows to roughly $12,000. Looks fine on paper. But if inflation averaged 5% over those same 20 years, the real purchasing power of that original $10,000 has been cut by more than half. Your account shows more money. You can buy less with it than you could when you started. That's not growth. That's decline wearing a disguise. Now here's the part almost nobody talks about: opportunity cost. Every dollar sitting in a low-interest savings account is a dollar that isn't out working for you somewhere else. Wealthy people don't hoard cash. They own things: stocks, real estate, businesses, index funds, bonds, assets that can appreciate or generate income because they represent ownership in something productive. A savings account owns nothing. It produces nothing. You're lending your money to the bank at a low rate, and the bank turns around and lends or invests it at a much higher rate, pocketing the difference. When you only save, you're on the losing end of that trade. Every single day your money sits there. This is where investing changes the entire equation, through something called compound growth. Invest in an asset that averages 8 to 10% a year, roughly the long-term historical average of a diversified stock index, and your money doesn't just grow. It grows on itself. Year 1, you earn a return on your original amount. Year 2, you earn a return on that original amount plus everything you already made. That stacking effect turns a straight line into a curve that bends sharply upward the longer you leave it alone. Go back to that same $10,000. At 9% a year for 20 years, instead of $12,000, you end up with roughly $56,000. Same person. Same discipline. Same 20 years. A completely different outcome, because of one decision about where the money went. Now I know what some of you are thinking. Investing sounds risky. And you're not wrong, investments can drop in the short term. But here's the uncomfortable truth: keeping everything in savings isn't actually safe either. It just feels safe, because the number never drops. It feels stable because you can't see inflation eating it in real time. Investing carries visible, short-term volatility. Saving carries invisible, long-term erosion. And historically, over long stretches of time, diversified investments have consistently outpaced both inflation and savings accounts, even after accounting for every crash and every recovery along the way. None of this means saving is useless. Saving still matters, a lot. You need it for emergencies, for short-term goals, for peace of mind. Without savings, one unexpected expense can force you into debt or make you sell investments at exactly the wrong time. Saving isn't the enemy here. The problem is treating saving like the finish line, when it was only ever meant to be the starting line. Saving builds the safety net that gives you the stability to take the next step, investing what's left over into things that actually grow. Think of it like this. Saving protects the money you already have. Investing grows the money you don't need right now into something much bigger for your future. Two completely different jobs, and confusing them is where most people go wrong. They save everything forever and never make the leap into investing because it feels unfamiliar or intimidating. But by avoiding that step, they unintentionally lock themselves into a far smaller financial future than they could have had. There's a psychological trap hiding in here too. Because saving feels responsible, people stop the moment they start doing it, and feel accomplished for stopping there. I'm saving every month, I'm doing great. And compared to someone who spends everything they earn, sure, that's progress. But compared to someone who builds an emergency fund and then invests everything beyond it, the saver ends up decades behind, even with identical discipline, identical income, identical effort. The gap isn't about how hard either person worked. It's about where the money went after it was saved. So what does this actually look like in practice? Start with a basic emergency fund, 3 to 6 months of essential expenses, kept somewhere safe and accessible. Once that's built, everything beyond your short-term needs should start flowing into investments. That could be as simple as a diversified index fund spreading your money across hundreds of companies instead of betting on one. It could include a retirement account with tax advantages. You don't need a huge amount to start. Even small, consistent contributions compound dramatically over long periods. And the earlier you start, the more time your money has to grow on itself, which is exactly why starting now beats waiting to invest a bigger amount later. Here's the core of it. Saving keeps your money safe. Investing makes your money grow. Save only, and you're protecting your money from disappearing fast while letting it shrink slowly through inflation. Save for stability, then invest for growth, and you give your money an actual shot at building real wealth. Wealth isn't created by hoarding cash, it's created by owning productive assets that increase in value over time. That's the step most people skip. And it's the single biggest reason disciplined savers often end up with far less than they expected, while consistent investors, even starting small, end up building something real. So don't stop at saving. Use it to build your safety net, then use investing to build your future. That shift, from just saving to saving and investing, is what separates the people who build real wealth over a lifetime from the people who work just as hard and stay stuck anyway.